Ever wondered how a global apparel powerhouse stays profitable when the world gets complicated? Today, we are diving into a strategic analysis of Pearl Global Industries, also known as PGIL, and their Q3 FY26 performance. Titled Resilience in Complexity, Growth in Motion, this report reveals how the company is successfully balancing double-digit growth with strategic de-risking. The numbers are impressive. Q3 revenue grew over 14% to 1,170 crore, while the overall 9-month revenue reached 3,711 crore. Quality is also on the rise, evidenced by an ICRA credit rating upgrade to A+ with a stable outlook. But the real game changer is a major catalyst starting February 2026, a new reduced U.S. tariff rate of 18%, which acts as a direct profitability booster. Looking at the revenue trajectory, we see a fascinating shift. While volume actually dipped slightly from 56.1 million pieces to 53.8 million pieces year over year, total revenue climbed by over 13%. This proves PGIL is prioritizing revenue quality over volume quantity, driven by a strategic move toward high value-added products in Vietnam and Indonesia, where realization per unit is up. When we peel back the layers of their 10.1% normalized EBITDA, we find a hidden value. The reported 9.0% margin was impacted by specific one-offs like ramp-up costs and reciprocal tariffs, which totaled 42 crore. Once adjusted, the true operational efficiency is in the double digits, reflecting a much stronger underlying reality. Geographically, PGIL has built a massive strategic moat through diversification. Hong Kong remains the global mainstay at nearly 50% of revenue, followed by Bangladesh at nearly 20%, with Vietnam and India each contributing roughly 13%. This multi-country manufacturing setup acts as a natural hedge against regional geopolitical instability. The forward outlook is even brighter thanks to a macro pivot in India operations. Not only are U.S. tariff penalties being removed, reducing rates to the standard 18% in February 2026, but upcoming free trade agreements with the EU and UK are expected to open doors to premium markets and significantly boost India's segment profitability. PGIL is also strengthening its credit and asset structure. With a net worth of 1,310 crore and a healthy reserve accretion, the company is leaning into an asset-light model for future expansion. They're maintaining strong capital efficiency, evidenced by the holding company receiving 43 crore in dividends from subsidiaries. As of February 7, 2026, PGIL's trailing PE ratio sits between 32 and 34, which is slightly below the industry average of 35. With a market cap of approximately 8,466 crore, the forward PE is estimated to drop further as we factor in projected growth and margin expansion triggers. The reward for the bull case is clear: direct margin expansion from U.S. tariff reductions and capacity readiness in Bangladesh and Vietnam. However, investors must weigh this against risks like raw material volatility, supply chain disruptions from geopolitical instability, and rising finance costs in India, which currently sit at 3.3% of sales. In terms of governance, the quality is high. PAT and EBITDA growth are perfectly aligned at roughly 14%, and management has been transparent by clearly identifying 42 crore in one-off costs. While we monitor the impact of lease renewals on finance costs, no material impact is expected from new labor codes. The final verdict: it's an accumulate rating. PGIL is a resilient player, successfully navigating global supply chain shifts by moving toward high-value products. The key pivot point to watch over the next 2 quarters is the margin improvement in India operations following the U.S. tariff penalty removal. If you found this deep dive into Pearl Global Industries valuable, save this video for your own analysis. For more smart investing insights and market breakdowns, make sure to follow ZinvestZ. Remember, this is for educational purposes only and is not financial advice.